In today's video, we will look at new data that was recently out from Redfin, and then I will also share with you an article that I saw on fortune.com that seems to suggest that we might have hit the bottom of the housing market. Hi, my name is Mac Rogers. I'm a real estate broker here in the San Francisco Bay Area. If you want to know what's going on in the real estate market, whether it's the general real estate market news or real estate market here in the Bay Area, this is the channel for you. You should check out my other YouTube videos. Okay, let's start with the Redfin update. In their most recent report, they said that in the current housing market, homes are selling at a slower pace than they have in months. No surprise here. I think and I believe that if you have been following the news about the housing market lately, that's what it's all about. That's everything that's in the news. And according to the data from their 4 weeks ending in January 8th, homes are spending more time on the market, with a typical home being listed for 44 days before selling. This is the longest time on the market since April of 2020, and it's contributing to the biggest annual inventory increase on record. Furthermore, pending home sales have dropped significantly with a 32% decrease compared to the same time period last year. Again, that's been all over the news as well. Pending sales, which is a leading indicator of future sales, have been dropping for the past 5 or 6 months. This is the lowest level of pending home sales on record. Additionally, mortgage purchase applications have dropped to their lowest level since 2014. All these things go hand in hand. It actually starts with mortgage applications. Purchase applications, to be exact. If less and less people are applying for mortgages, that's another leading indicator, and in the coming months there will be, less sales. The slow pace of home sales can be attributed to a combination of factors, including high mortgage rates and extreme winter weather at the start of the year. I gotta say that even here in sunny California, this time around the weather is affecting the market. You've most likely seen in the news flooding, mudslides happening everywhere. However, and here's a bit of good news that later on I will segue to fortune.com's article. There are indications that early stage demand for homes is increasing. For example, Redfin's Home Buyer Demand Index, which measures tour requests and other buying services from Redfin agents, has posted a 6% increase over the last month. Additionally, Google searches for homes for sale are on the rise also. The decrease in mortgage rates, which dropped to 6.33% from their November peak of over 7%, may also be attracting buyers back into the market. This decrease in rates can save the typical U.S. home buyer roughly around $250 monthly housing payments. It is not only mortgage rates that's encouraging buyers to start looking for homes again. Buyers may also be encouraged by signs of improvement in the economy, with inflation easing in December for the 6th month in a row as wage growth also softened. According to Redfin's Deputy Chief Economist Taylor Marr, this positive economic news and the Fed's likely continuation of easing interest rate increases can cause mortgage rates to continue gradually declining, bringing back some home buyers in the coming month. The decrease in monthly mortgage payments and the latest inflation and employment data also lower the chances of a recession, which can make buyers more confident in their decision to buy a home. Let me share with you some key points or highlights on their report before I move on to the fortune.com article that I mentioned earlier. They said home prices fell from a year earlier in 20 of the 50 most populous U.S. metros. The typical U.S. home sold for $351,250 during the 4 weeks ending January 8th. That's up 0.8% from a year earlier, but down 10% from the June peak. Take note of that. It still went up, but not at the same pace or level as we've seen in the past. 11 metros saw price declines a month earlier. Here are some of the places that went down. 10.6% year over year in San Francisco, 5% in Seattle, 4.9% in San Jose, 4% in Austin, 3.8% in Detroit, 3.7% in Phoenix, 3.4% in Oakland, 3% in Boston, 3% in LA, 3% in Sacramento, 2.6% in San Diego, and 2.5% in Chicago. Following cities: Portland, Anaheim, Riverside, Newark, New Jersey, New York, Pittsburgh, and Las Vegas, and Washington, D.C. These cities fell by 2% or less according to the report. This marks the first time Las Vegas prices have dropped year over year since at least 2015. It's the biggest year over year price drop in San Francisco, Seattle, Phoenix, Chicago, Boston, Portland, and San Diego since at least back in 2015. So that was the Redfin latest market update. Now let me share with you this article that I saw that kind of surprised me. The headline reads, "Up from here, free fall in housing market activity just concluded," says Capital Economics. This was really intriguing and eye-opening. I was thinking, am I off base again? When the pandemic hit, I was telling my buyer clients that there would be a 3 to 6 month window of opportunity to buy, especially here in the Bay Area. That lasted all of 3 weeks. I was way off. Everybody just shrugged off what was going on. Now this, I've been telling my clients that it would be a not so competitive market for the first half of the year and quite possibly the whole year, meaning, there's going to be less competition out there. So you can imagine when I saw this article, I was like, what? The downturn or crash never even got here? Let's look at what Capital Economics had to say about this and see if there's merit to what they are saying. Their economist Sam Hall said this: "There are growing signs that the housing market activity may be close to a trough." Okay, let me stop here for a second. He said that there are signs we are at the trough, meaning we could be at the bottom. Now, I have to tell you that this is not the first time that I've heard an economist say this, but I kind of just brushed it away the first time I heard it. I mean, after all, it's only January. It seems like it's too early to be at the bottom. He continues on. "The decline in mortgage rates over the past couple of months has led to a small improvement in affordability and a rise in home buyer sentiment, albeit from a record low." He probably means that mortgage rates haven't gone up like the last half of last year. Now, it's true that this January rates have improved a lot. And it's also true that we are starting to see home buyers that are glad to see that these changes. He continues on to say, corroborating this, mortgage applications for home purchase have ticked higher in the past couple of months, which should feed through higher sales. Again, also true, but still not the same levels yet. Also, I would add that we don't know yet if this is just a blip, meaning temporary. As far as it meaning more people applying for mortgage translating to higher sales, I still doubt that. He continues on to say, but any recovery in the housing market activity this year will be tepid. Stretched affordability, a weakening economy, and falling house prices will all weigh in on activity. As a result, we expect 2023 will be the weakest year for sales since 2011 and for starts since 2014. Meanwhile, we think house prices will need to fall further by 6 to 7% to bring affordability back to a level that will support more normal levels of demand. His last part is kind of crazy to me. He starts off by saying we may be at the bottom, but ends it with we need a drop of another 6 to 7%. Well, if we do that, that would mean we are not at the bottom yet. And I think this is the case and would not be surprised if we go down more. I think everything is dependent on the Fed's next meeting. If they continue to tighten, then it's going to be tougher for home buyers. As a result of this, we will see the number of transactions go down significantly and prices pull back, I'd say around 5% overall. Now, you might see numbers being thrown around like 20%, 25%. Normally, what they are referring to here is from the peak and then at the bottom. So when you average it out, it won't be as bad. We actually still might end up on the positive side. It's important to note that while there may be signs that the housing market is reaching a turning point, it doesn't mean that home sales will immediately bounce back. The reality is that housing affordability is still at historic low, with home prices rising 41% in just over 2 years and mortgage rates jumping from 3% to over 6% in just 1 year. These factors will continue to weigh in on the market and impede any swift recovery. As of last October, the Case-Shiller National Home Price Index shows that U.S. home prices dropped 2.4% from their peak in June of 2022. The research firm also predicts that from peak to trough, U.S. home prices will have fallen between 8 to 10%. Similarly, Moody's Analytics chief economist Mark Zandi also believes that the U.S. home sales are nearing their bottom while national home prices have further to fall. He expects the peak to trough fall in home sales to be 10%, with overvalued housing markets in the West being affected the most. If predictions of these researchers are accurate, it would mean that home prices would slide back to October of 2021 levels, making the second biggest home price correction of the post-World War II era. But relatively tame compared to the 26% nationwide home price correction seen during the housing bubble. It's really important to read between the lines when you see headlines like this, because as a consumer, you might be thinking, oh, they're saying another 20 to 25% decline. That causes you not to do anything because thinking there may be more to come. But really, what they are saying is from peak to bottom. So while we do not know exactly if we are at the bottom, this is what I know, and especially true here in the Bay Area. The market has cooled off significantly. Buyers have stayed away because of higher mortgage rates. Proof is in the numbers. During the months of December, data shows that sales have fallen around 37% when compared to 2021. And we continue to see weakness. Pending home sales have continued their decline every month. This continued decrease in sales activity comes after a surge back in August, which saw pending home sales reach their highest level in over a decade. Experts are saying this drop in sales is still, get ready for this, the lack of available homes on the market, as well as ongoing economic uncertainty caused by the ongoing COVID-19 pandemic. Despite this setback, experts remain optimistic about the future of the housing market, with mortgage rates eventually leveling and pent-up demand continue to drive interest in buying a home. However, they also caution that a sustainable recovery in the housing market will depend on an increase in the supply of homes available for purchase. This is why home buyers looking to purchase a home are still facing increased competition and rising prices as the limited supply of homes on the market keeps driving up demand. Also worth noting is that you have to pay attention to where you are and what is it like in your market. Real estate is very local, and when these numbers get thrown around, most of the time it's the national average. For example, here in the Bay Area, hardly anyone can relate to the median national home price that is less than $400,000 because you can't get anything for that here. Well, actually, you can get something. The one thing that I want to tell you, my Bay Area viewers, is that when they talk about big declines in home prices and transaction, a lot of that is out here in the West because of our high price points. That being said, what do we make of this current situation that we have? Here's what I think. First off, I think that this market will surprise everyone in terms of how fast it's going to flip. Meaning, while people are expecting a downturn that's more severe and prolonged, it most likely won't happen. Because I don't see the Feds raising rates or continuing to raise rates at their current pace. I believe that moving forward, they'll be more prudent about it simply because I believe that we have already started to feel the effects of their tightening. Further aggressive tightening could lead us to a more severe downturn, and no one wants that. Second, once we see the Feds easing up, there could be a sense of relief in the market and the sentiment will start to change from negative to positive. I believe that there are a lot of negativity priced in the market right now, and this is why rates are much higher than where it could be. And third, the most important of all is that demand is still there and inventory is still in short supply. So when we see all these easing and some semblance of surety in the overall economy, I believe that the buyers on the sideline will come back so fast. I truly believe that right now there are still a lot of buyers out there that can afford to buy at these prices and at these mortgage rates. The only thing stopping them is that they are scared of what is going on in the economy. Scared that they might lose their jobs. What do you guys think? I'd like to read your thoughts below. Do you think we're at the bottom, or is there still a huge crash coming?